Good morning. It's August 18th, 2020. Can't believe it's already August, but thank you for joining us today for our quarterly investment update. Look back at Q2 as well as our outlook going forward. I am Brad Shively, Vice President at Capital Management Corp, and I'm pleased to have with me Tim Call, Chief Investment Officer of Capital Management Corp, Mark Livesay, Vice President and Portfolio Manager of Capital Management Corporation, and a new addition here to Capital Management Corp is Joey Opekin. I hope I pronounced that right, Joey. And Assistant Portfolio Manager, and like I said, new addition. We are continuing to grow here, and as we find quality, high quality candidates, we will continue to add them. And we're very pleased to have Joey. He has a spectacular background in investments, and we're really pleased to have him here. So he's joined us here. And with that, I will pass it over to Tim Call, who will make some opening remarks. Tim?
Thank you for joining us this morning. We hope you and your families are safe and well. These are stressful times for the economy, businesses, and society as a whole. Our top priority continues to be the safety, health, and financial well-being of our clients and employees. When needed, 100% of our workforce has complete remote access from their homes. Past investments at CMC have allowed for the ease of this transition. Our ability to embrace the digital landscape allowed for client-wide webcasts like these and client-specific Zooms. The investments we made to differentiate our company resulted in timely portfolio shifts and immediate client service. Our response times were fast and our actions precise. Throughout our firm's 56-year history, and through the careers of our investment professionals, we have worked through bear markets, recessions, and crises. We remain actively engaged with the management teams of the companies in which we invest. Internally, we share pertinent information, knowledge, and wisdom, and have frequent internal meetings. At CMC, one of our most important jobs is to save clients from normal human emotions. The depths of fear and despair occur at the lowest valuations, and they actually create the lowest valuations in the market, as most investors sell at the bottom. Historically, the strongest market returns quickly follow those worst periods, so it's important that we have clients invested at the bottom. Our top talent and unique client-serving portfolios distinguish us from the industry. We've seen our investments and our people pivot quickly to adjust to these uncertain times. Our results this summer demonstrate the caliber of our talent, the strength of our long-term strategies, and the distinctive culture of our team approach, and the complete cohesion around fiduciary duty and our client well-being. In the long run, this is a combination that positions our clients for long-term results. And Brad, if you'll summarize the period that we've just been through.
Absolutely. And before I do that, I just wanted to let everyone know we will be taking questions here at the end. And the way we do these webinars, for those who have not done before, you can type in under the questions your question to us, and we'll address it there at the Q&A portion of this event. And now, jumping back to what Tim had mentioned, it's unbelievable it's taken less than 6 months here. The U.S. economy has continued to grow through February of this year, peaking at $21 trillion of annual economic activity. And then starting in March, virtually 20% of the economy was shuttered overnight. We've never seen anything like that in our history. Unemployment rose more than any time since the Great Depression. New York Stock Exchange experienced the fastest correction, as well as the fastest bear market in its 228-year history. And we've seen protests the level of what we haven't seen since the Vietnam War. What's been most encouraging, though, has been the U.S. reaction, which has been just as swift and historic. In 1 week, the Federal Reserve purchased more bonds than it did throughout all the quantitative easing between 2007 and 2009. Overnight interest rates were moved to zero. The federal government enacted stimulus packages totaling $3 trillion. Many transitioned to remote work or virtual education. And despite changing mandates, face masks and voluntary self-quarantine have become more the norm than the irregular. So with that, I'm going to pass it over to Mark, who is going to start us out in our slide deck here. Mark?
Thank you, Brad. I appreciate that. And the first chart has to do with COVID-19 and confirmed cases and fatalities. So this is all top of mind for everyone, but we can see that the virus on the light blue line on the right chart did make a resurgence this summer. That was in part due to increased testing, but in part due to the opening of the economy. The good news is even though confirmed cases of COVID rose to a peak that we had not seen before, fatalities did not match that prior peak. So the fatality level came down relative to confirmed cases, which is obviously a positive. Another positive is we have seen the confirmed cases start to dip back down, so the line is no longer going up, which is encouraging. And although maybe Russia and Vladimir Putin have announced the vaccine, we would maybe wait until we get a FDA-approved vaccine. And we do suspect that many healthcare workers and first responders may get that vaccine around year end. We believe that most people will probably be towards the beginning of next year getting the vaccine, and kind of ironically, this thing might have about a year impact. So we might be getting vaccines and things might be getting somewhat back to normal right about a year from when everything went haywire in late February, early March. So we do see the impact on industry on this second chart. These are very, very short-term indicators, which we typically would want to warn about and be careful of putting too much reliance on a short-term indicator. But you can see the dramatic impact in the beginning of March on the entire economy. You can see that TSA traveler traffic was down at its worst point, 96%, so almost stopped entirely. It has recovered, but is still down 76%. U.S. seated dinners fell to zero, essentially, which is obviously unprecedented, and has recovered, but not to where I'm sure most restaurant owners would like. It's still down 57%. Mortgages, on the other hand, they did dip. They were down 35%, but now have risen and are 22% higher than where they were before the pandemic hit. That is, in part, we believe, due to low interest rates, which we'll kind of get into later. And also consumer credit and debit card transactions fell a little more than a third, and now we're back at about 92% of where they were pre-pandemic. So the fact that things have begun to recover and are moving the right direction is encouraging, but we still have a ways to go, particularly in the travel and hospitality areas, where we think the vast majority of the pain in the economy has been felt or will be felt. Brad mentioned the unprecedented Federal Reserve action, and this chart kind of goes, it's a good example of just how swift and how massive the action was. So the Fed has purchased roughly $3 trillion of bonds. This is since March. We can see that that's roughly equal to what they did over the financial crisis period. However, that period began in 2008 and it really ended in 2015. So we've done what we did for the financial crisis in a few months, what we did in many years back then. The federal government, which is not on this chart, has also acted swiftly, as Brad mentioned, spending roughly $3 trillion in pandemic stimulus. We believe they are likely to add more. The news on a day-to-day basis on getting a deal between the Democratic House and Republican executive and Senate is not good, but we think that's just part of the political process, and we do think there will be a deal in the relatively near future. So all told, we think that between the federal government and the Federal Reserve, they could be adding $9 trillion by the end of the year. $9 trillion is obviously a huge number, but in relation to the U.S. economy, which last year U.S. GDP was $21.5 trillion. So you've got, if money changes hands 2.5 times, less than 2.5 times, the stimulus should be more than what the entire U.S. economy was in 2019. So it really is an unprecedented amount of money and an unprecedented speed. And so, of course, you worry when you do this sort of thing, what might be one of the unintended consequences. And we do believe that when things get more back to normal and you have this giant pile of money which has been put into the economy chasing roughly the same amount of goods and services, that we could see some inflation creep up. And so I'm going to pass it to Joey to talk about some inflation that we may have already seen in the bonds market.
Oh, thanks, Mark. Yes, the inflation, yes. So as seen in this next chart, inflation is already apparent in bond prices. So as Brad and Mark have already mentioned, the government has funneled an enormous amount of money into the bond markets within the past few months. And of course, this increased demand has inflated bond prices, which makes interest rates fall. Because as bond prices rise, interest rates decline. And you can see based on this graph from, I think, 2013, the 30-year Treasury has declined from about 4% down to 1.3. And to give a better perspective from last year, the 10-year bond declined to pretty much half of the rates that is today. So about 1.59% last year, and today it's around 0.7%, which is crazy. And while these are historically low on the absolute level, the yield curve is not inverted anymore. Now, inversion is when short-term bond rates are higher than long-term bond rates. Now, inverted curves can predict recessions, which was about a year ago. However, in recent months, the bond curve is predicting an improving economy, which we find very encouraging. Now I'll pass it over to Tim to discuss the stock market.
Thank you, Joey. Excessively low interest rates and record money printing have combined to push the overall value of the largest growth stocks, high-tech stocks, to very high levels. And this has left the broad market indices top-heavy. So the mega caps have run and run up, and some we think have run up too far, while the other stocks have been ignored. And when that happens, just a few stocks can represent an enormous part of most indices. For the S&P 500 made up of the 500 largest stocks, just 2 stocks represent 12% of that index. There are 250 stocks within that index that represent less than 11% of the index. So 2 stocks out of those 500 represent more than 250 other components combined. And so that's a rather top-heavy index. And we've seen that across many indices. And this performance discrepancy between the large stocks and the large growth stocks and others can be seen on this table. It's quite visible when comparing large cap stocks to small cap stocks, as seen comparing the S&P 500 to the Russell 2000. It's just an enormous difference in performance. The effect at the bottom of the page seems rather historic. I believe it's more extreme than what we saw in 1999 when we compared growth stocks to value stocks. Long term, when we look over many decades, small caps tend to outperform large caps and value tends to outperform growth. So this has created some great opportunities. So some of the large indices have now become expensive, yet the average stock might have actually declined in value. So this is a great time to select individual securities that are overlooked, undervalued, and have high growth potential. And Mark, if you'll review where we're finding some of those great opportunities today.
Thanks, Tim. I think we've shown this group before, but trends we believe that we can make money in. First off, being the one Tim just highlighted, valuation discipline, so value over growth, market cap, so potentially small and mid over large, and cash dividend growth. Cash dividend growth is something that is not talked about a lot in the financial press, but is incredibly valuable to the holder of that asset if they can grow their income with inflation or potentially above inflation, and those dividends are relatively safe. We feel very good about the ability of an equity portfolio to provide income for living expenses going forward. Within that, we see some 5G names that have not run. We think the 5G build out is happening. It was happening prior to the pandemic and maybe was slowed a little bit, but will certainly continue after the pandemic. Healthcare, obviously the need for healthcare and healthcare technology and learning about disease has been very highlighted to a great extent this year. We believe those stocks still are very attractively valued. Internet sales and delivery with logistics and distribution, with people maybe not stepping foot in stores as much, we think that's a trend that could continue. Lithium batteries, with many car manufacturers going to electronic vehicles. We think the demand for lithium and lithium batteries will just be increasing over the next 3 to 5 years, despite maybe 1 or 2 months or a year oversupply or undersupply, because it is a commodity. We feel very good about where that's going to be in a couple of years. And then shifting consumer trends. I think all of our lives have been changed dramatically this year. And so we're eating at home more, we're working from home more, and we're entertaining ourselves at home more. So companies that are in good positions to take advantage of those shifting trends should do well into the future. And I think some of the trends will obviously go back to quote unquote normal when the virus subsides. But I think some of these trends will have taken a step function up and will continue to grow over what they did this year. So I think we're going to turn it over. I'll turn it over to Brad, and we'll go back to the Q&A.
Thanks, Mark. Yeah, so at this point, if you have any questions, please feel free to type them in, and we will address them as we go through here. We have one that was sent in already, and I think we'll pass this one to you, Mark. What is your outlook for financials in this low interest rate environment?
Thanks, Brad. So I think it depends on what your financial is. The financial industry is quite diverse now. So we feel good about financial companies that might be involved with transactional things, such as mergers and acquisitions and restructurings. What we wouldn't feel quite as good about was a financial company that was just primarily dependent on spread income. So meaning they're going to lend long and borrow short, which is the traditional bank or thrift model. With interest rates this low, the net interest margins of those companies will likely be under pressure. Another thing is when you have a big event in the economy, you might have some credit issues. So we wouldn't feel so great about your kind of plain vanilla bank or thrift, but those transactional based financials, we believe are for the most part at very good valuations and should have great earnings the back half of this year and into 2021. So we feel very good about those. So I think you have to kind of peel back the onion a little bit and look deeper into how the financials actually make their money.
Great, thank you, Mark. Next question is, according to your newsletter, you mentioned why most of dividend-paying stock holdings should increase, not decrease their dividend this year. Why is this still the case or even important? Tim, why don't you take that?
A lot of, well, to be one of our holdings, you have to have positive cash generation. And what we saw with our holdings is where they needed cash, they cut back on their share buyback activity and cut back on some of their capital expenditures. This allowed them to preserve and in many cases continue to grow their dividends despite the downturn in the economy. So now as the economy recovers, they should be able to continue to pay those dividends. It's rather important because you can create a portfolio these days with growth stocks that has a very attractive dividend yield of even up to 4%. And when we compare that to the 10-year U.S. Treasury, close to 0.6%, there's an extraordinary difference there. And if institutions are withdrawing money from their portfolios every year, or if retirees need to live off of their portfolios, you can't really do that with a 0.6% interest rate. But with dividend-paying stocks, especially at a 4% yield, you can withdraw 4% of your portfolio each year without touching principal. So the principal can continue to grow long-term and grow faster than inflation while you still are using cash to meet your day-to-day needs. So it is important to preserve and grow dividends over time. And we have found that the vast majority of our companies can preserve their dividends, and actually the majority are still growing their dividends this year. So we're rather happy about that.
Great. Next question we have coming in is very timely around the election and what we think the results of the election might have on the markets. Either Tim or Mark, you can jump on that.
That's a wonderful question. So this is a graph that shows how the stock market has done under different administrations, and we're watching carefully on a issue by issue basis, and also on how much of Washington changes. If it becomes all Republican, all Democrat, or if it's a mixed Washington with the houses of Congress and the presidency, and that would affect different sub-industries a great deal. So in general, the stock market rises over time, whether under Democrats or under Republicans. If it were to go to all Democrat, we do have to worry about the possibility of different tax rates increasing, regulations increasing. And regardless of whether it's Democrat or Republican, we are greatly concerned about future inflation increasing. And all of these affect different industries differently. But in general, when inflation comes, historically, certain stocks and industries do better than others. And stocks can do a lot better than cash, and long bonds can lose a lot of money if inflation picks up. So this is a very important subject, but it's also rather complicated, and we have to look at it on a very specific basis, industry by industry. And it helps as well to be in the market leaders or the leaders of industrial niches, as opposed to third or fourth tier companies within those niches of business.
Great, thank you. Right now, we're not getting any more questions, so we claim to try to keep it down to 25 minutes at tops here. So I think what we'll do here is end this. But if you do have any questions in the future, please feel free to reach out to myself, Tim, Mark, or Joey. Be very more than happy to answer any questions. So at this point, we will conclude the webinar.